Hello, we're going to go through the elements of PepsiCo's 2013 annual report. From Chapter 1 in your text, the elements of the annual report include the financial statements, but also other elements to help you understand them, like management's discussion and analysis, the notes to the financial statements, and the auditor's report. We're going to look through PepsiCo's annual report for these elements. And remember, the reports and financial statements shown in your text are simplified for pedagogical or teaching purposes. Annual reports of real companies will look slightly different and be more complex. They might use slightly different words, but knowing the structure of the report, hopefully you can find the things you want. My goal for you is to be able to read real financial statements, understand companies you may want to work for or invest in. It's an art. Becomes a little easier with practice. We'll look at PepsiCo's annual report to get you more comfortable with the process. Those of you who live in the dorms use PepsiCo products in your cafeteria. So one thing we'll notice is annual reports tend to have plenty of pictures and promotional messages in addition to the financial statement and other elements. The Pepsi products look good enough to eat: Lay's, Gatorade, Quaker oatmeal. Firms like PepsiCo, who are publicly held, meaning they issue stock or bonds to the public on an exchange in the United States, are required to file Form 10-K with the Securities and Exchange Commission, called the SEC. This contains the financial statements, elements of the annual report, and other required information. Firms often combine the annual report and 10-K like PepsiCo. Within the annual report, the management discussion and analysis usually precedes the financial statements. You'll notice that this takes, for PepsiCo, 32 pages. It gives an executive overview of the financial statements, discusses operations, customers, competition, distribution, discusses accounting policy, more in words than technical terms, and financial results, whether you can compare last year to this year. How did we do this year overall? How did we do by division? We have Frito-Lay, Quaker Foods, Latin American Foods, PepsiCo Beverages in the Americas, and also divisions in Europe, then the Asian, Middle East, and Africa. It discusses and is required to discuss liquidity, how companies pay their short-term bills, and capital resources, long-term sources of financing. Note that the four financial statements that we're going to review only take up 6 pages of the annual report. The notes provide more details on the financial statement numbers and includes information about accounting methods. Financial statements might include one line for an item. We want to know what details, what subdivisions are in that item. 3 types of inventory, for instance. Raw materials, work in process, and finished goods might be in the notes. The auditor's report is only 1.5 pages long. An auditor is an outside accounting firm that looks at the financial statements to give us more assurance that this isn't just management telling us the numbers, that they've looked at it for fairness and to make sure there's control in the accounting system. One thing that you'll notice, if we start with the income statement, they usually have this word consolidated. Consolidated means PepsiCo owns several companies, Quaker Foods, Frito-Lay. They add the results of all the companies that they own to get net income, the companies that they control. So what they do is it combines all the economic entities that Pepsi controls into the reporting entity for the consolidated statement of income. One other thing you'll notice is that reports are given not to the dollar and cent like your bank account, but in millions or thousands of dollars usually if a company's big enough. So that for 2013, PepsiCo has net revenue of $66.4 billion. If we put all the zeros after it, we'd see it's $66 billion. Notice that this has revenue, it has various expenses, and it has net income. The types of expenses: cost of sales, meaning what's the cost of the soda or the oatmeal or the Fritos. Selling, general, and administrative expenses like advertising, amortization of intangible assets we'll talk about later in the course, interest expense. Notice there's a couple lines here for net income. We care about net income attributable to Pepsico for shareholders of Pepsico, and net income for Pepsico shareholders is $6.74 billion. There's a little bit subtracted out before you get to that because PepsiCo has net income, but it doesn't control 100% of all the companies that it adds together for consolidated results. The consolidated statement of equity contains the statement of retained earnings in your book, plus additional information about the changes in other equity accounts. We'll see more about this in Chapter 2. So we said first we can prepare the income statement, get net income. We need net income to add to the beginning balance of retained earnings. We add net income, $6.74 billion, subtract dividends paid out to shareholders of PepsiCo of about $3.4 billion, and we get the ending balance of $46.420 billion in retained earnings. So we needed net income from the income statement to do the statement of retained earnings. We need ending balance of retained earnings for $46.42 billion to put into the balance sheet. So in our books we say first the income statement, then the statement of retained earnings, then the balance sheet is the third financial statement. Sometimes it might be called something like the statement of financial position or similar names, but if it has total assets and total liabilities and shareholders' equity, you can be sure it's a balance sheet. PepsiCo has $46.42 billion in retained earnings, which agrees with the number that we calculated in the statement of retained earnings. And you'll notice that we're going to use the ending balance of cash and cash equivalents of $9.4 billion in 2013, and this will link with the end of statement of cash flows. Also, it will have information from last year's cash and cash equivalents. The statement of cash flows attempts to explain why cash went from $6.3 billion to $9.4 billion. The basic effect, so we know the change in cash from the balance sheet, but what we really want to do is explain why it changed. We have cash flows from operating activities that cause cash to increase, cash flows from investing activities, which for PepsiCo cause it to decrease, and cash flows from financing activities are the three main reasons. There's also the effect of exchange rates, which is something that's a little beyond our scope right now. The most important thing that investors look at is cash flows from operating activities. They include things like cash received from customers, cash paid to suppliers, to employees, and to lenders for interest. The cash flow format, which starts with net income and adds back adjustments to get to cash flows from operating activities, is called the indirect method, which most companies use to compute cash flows from operations. Cash flows from operating activities of $9.7 billion is greater than net income of $6.7 billion because not all expenses are paid in cash in this period. Cash flows from investing activities. Cash is generated when we sell long-term assets like property, plant, and equipment and investment securities, and it's used when we buy them. Note that capital spending of about $2.8 billion is our biggest amount of cash from investing activities. And overall, there's a cash outflow of $2.6 billion. Just like when your parents traded an old car to get a new car, you might get something from selling the old item, but usually growing companies spend more on new property, plant, and equipment. So this is not unusual, and it's possible they generate a lot of cash from operating activities to pay for these things. cash flows from financing activities, cash comes in when you issue stock or you borrow money with the principal of a bond. It goes back when you repay the bond or when you give money to shareholders by paying dividends or repurchasing stock. Overall, for PepsiCo, cash went out of $3.8 billion because they paid dividends and they bought back shares, and this was larger than what they issued in debt or issued in new shares of stock. Overall cash increased by about $3.1 billion, and the reason why it increased is because cash flow from operations that increased was bigger than the outflows for investing in financing activities. Note that we see cash at the ending balance of 2013, $9.4 billion, and we also see cash at the end of 2012, which is the same as cash at the beginning of 2013 of $6.3 billion. Notes are required for publicly held companies like PepsiCo. They explain information in the summarized financial statements, provide details. Note 1 here tells the basis of presentation that they combine companies and consolidate companies they control, that they use generally accepted accounting principles. They talk about the different divisions of the companies. Note 2, and all companies have a note describing significant accounting policies. And, for instance, sometimes there's more than one method that they can choose and still comply with generally accepted accounting principles. If you notice, on the balance sheet, they have one number for property, plant, and equipment, $18.575 billion. If you want to know what types of property, plant, and equipment and how much they originally cost, you look at the footnote. So it gives the original cost of land, buildings, machinery, and construction, buildings or equipment that they're building for their own purposes. It also deducts something called accumulated depreciation. Property and equipment that wears out, land doesn't wear out, but plant and equipment does, and we expense a portion of their cost over their useful life each year in depreciation expense. And because we've had these many years, the sum of depreciation over the life of these assets is about $18.4 billion. So we get the original cost, the different types of property, plant, and equipment, and the amount of depreciation taken against them over their useful lives so far. We'll learn more about this later. The auditor's report contains the opinion of an outside auditor about the fairness of the presentation of the financial statements and footnotes in conformance with generally accepted accounting principles, which is called GAAP. Public companies like PepsiCo must also have their auditors examine control over their reporting system, so people can't just put things in there and make transactions up. The auditor's report has an introduction, a paragraph about the scope, internal control over financial reporting, definition, and limitations. But the most important thing is the opinion paragraph in the auditor's report. This is unqualified, which is a good thing. That means that it fairly presents, in all material respects, the financial statements and footnotes in conformity with U.S. generally accepted accounting principles. Also, they maintain effective internal control over their reporting system. So you have a sense that what goes in there is good, and they've used the principles the right way. Please feel free to use this presentation as a review before looking at other companies' annual reports. Good luck and get started, Jaspers.